Well, hey there, everyone. Happy Monday, October 27, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually beautifully sunny and not too cloudy Redmond, Washington. Great to I see a rainbow out my window. I think that's the first time I've actually seen a rainbow out my window. That's a good sign, I guess. Good sign for growth stocks, I guess. There are growth stocks at the end of today's rainbow, not gold, because gold is breaking down through the 21-day exponential moving average, as you'll see when we look at the chart of the GLD in a little bit. Growth stocks moving, as we say, onward and ever upward. This was an offense over defense, growth over value. Tons of optimism. Some might say euphoria here on a Monday in the last Monday trading wise of October. A lot of potential headwinds or tailwinds this week. We have the latest Fed meeting coming up, where the Fed is, essentially fully expected to lower basis points and lower rates another 25 basis points. We have, expectations about U.S.-China trade policy. A lot of optimism baked in there, which is allowing risk assets to go higher, particularly technology, more than anything. Semiconductors a big part of that. Tons of earnings, though. And I would say earnings, arguably the long-term trend in this market going back decades is driven by growth and earnings. And we're seeing that optimism. The question is, when does optimism turn into euphoria? If we haven't said it's euphoria yet, I don't know what we say on a day like today. But let's look at the charts and reflect on what we've seen, what we've learned. Let's talk about how we can apply the trend following toolkit to navigate as this market moves onward and ever upward. I like to tell people, and I was telling my market misbehavior premium members over the weekend in our weekly flight plan, now is not the time to become complacent. I hope you are continuing to ride uptrends as long as they persist. And I'm seeing a lot of growthy alphabet-like charts looking pretty good and making new highs. Apple making new highs. Those charts are good. Those charts are innocent until proven guilty. But just like pilots are taught, when things are straight and level, when everything's good, you don't just ignore your emergency plan. That's when you make sure you have a good strategy in mind. That's when you kind of check on all the systems and make sure things are good. You don't wait for the engine to cut out to figure out what you're going to do about it. When things are good, when conditions are fine, that's when you start preparing for emergencies. And I hope you are taking that time now, because the people that are complacent today are the ones that are going to get crushed tomorrow. And I don't want to see that happen to members of Market Misbehavior Nation. All right. With that as a long-winded intro, let's get to some charts here. The S&P making a new closing high. Pretty decent day, up about 1.25% to 68.75 and change. The NASDAQ Composite up 1.9%. The Dow Industrial Average, not a lot of industrial happening in the Dow, but for what it's worth, the Dow Industrial is up 0.7%. Mid caps up 0.33%. Small caps down slightly. So this is mega cap growth. Anything that I analyze, looking at the Magnificent Seven versus everything else, looking at large versus small, it's all favoring large. It's all favoring growth. That has been the trend off of the April low, with some random little short-term exceptions. That has been the story of this market. That narrative, as far as I can see it, has not changed. As a trend follower, I'm seeing a growth-led rally. We get good earnings from these leading growth names this week. I mean, it's going to be staggering to see where this market goes to. I did make a promise a long time ago to play the horn on the air if we close above 7,000 for the first time. I'm getting the mouthpiece out. I'm getting things ready to go. I'm getting the horn, dusting that off, getting that ready to go here. I can't promise it's going to be good. I haven't played in a while, but I'll do it. All right, what else? VIX continuing lower, right? It's a sort of risk-on vibe today in so many different areas. Credit spreads narrowing out. We saw that trend last week. That's continuing. We saw the VIX, getting lower through the course of last week. Today, back below 16. So we're in a low volatility environment. Conditions here in the equity markets, in the bond markets, in the options market, all saying, uptrend led by growth. No change in that trend. Our market trend model, I should say, no change from last week. So that remains bullish on all time frames. And again, that means overall the trend is strong. Bonds kind of mixed today. The TLT was up about 1/3%, opened lower, finished stronger. The yield curve was generally flat. You sort of expect a little bit of a pause going into this week's Fed meeting. We'll see what sort of updates we get on expectations for the short end of the yield curve and what the Federal Reserve may be doing here in the months to come. Market pricing in 25 basis point cut this week, another 25 basis point cut at the December meeting, rate cuts at the beginning of next year as well. That is where the picture gets a little cloudier. So we'll see if we get some updated estimates from the Fed governors and from strategists through the course of this week. Gold continuing to lighten up. Now, gold pushed above $4,000 an ounce, accelerated above there. I mean, just an incredibly exponential rise. Last week, pulling back to the 21-day exponential moving average, and that's where it stopped for the GLD today. With another 2.8% decline, that 21-day EMA has now failed. We're going to look at that chart here in a little bit. Silver down 3.6 as well. Crude oil basically flat today using the USO. Cryptocurrency. So over the weekend, Bitcoin got down to around 110,000. It's currently a little bit above there, around 114,000. But it's very interesting to me that while equities, I sort of generally say risk assets are moving higher, Bitcoin and Ethereum are not really moving higher right now, right? The equivalent here would be Bitcoin pushing above 125,000, which is the peak that we established earlier this year over the summer. We're not there. We're actually off quite a bit off of those previous all-time highs. So this is not an everything up rally. I would argue it is a growth stocks doing quite well kind of rally, with some other things like industrial, some aerospace defense stocks, and things like healthcare. You're seeing some other good charts. Don't get me wrong, they're out there. But generally speaking, there are some clear winners and some clear not so much winners. Take today, for example, right? Technology, the XLK up 1.9%. Consumer discretionary, the XLY up 1.4%. Communications services, the XLC up 1.4%. Then you take a big jump down to industrial, still up 0.6%, but up a lot less. You see financials up, but up a lot less. So again, this is growth, and particularly those FANG sectors, and particularly the biggest names doing remarkably well today. Only one of the 11 S&P sectors down, and materials were basically flat. Consumer staples, real estate up slightly from Friday's close. Breadth today, not great. And this is what I'm saying. I mean, this is one, okay, but not great. Around the S&P, which is obviously more of a large cap growthy kind of tilted index, 2-to-1 stocks up versus stocks down. But if you look at the New York Stock Exchange, 54% up, 43% down. So a little closer to neutral. The NASDAQ composite, you actually had more stocks down than up. In the small cap index, you had more stocks down than up. So it wasn't an everything rally today. This was growth and expectations about earnings from those growthy stocks really dominating the thinking. Obviously a lot of the threats to U.S. China, threatening sort of that tech dominance, and today sort of getting a definitely a change of character with growth accelerating to the upside. I mentioned our market trend model, pretty bullish here on all time frames. That's been the case for the last couple of weeks. Looking at the Magnificent Seven, again, a handful of these are actually reporting earnings this week, right? Microsoft, Alphabet, Meta, Amazon, Apple, all reporting earnings this week. We can see Tesla, which actually reported last week, up 4.3%. Alphabet up 3.6%. NVIDIA up 2.8%. They report later in November. Apple up to 2.3%. So, again, a number of these names pushing higher going into this week's earnings report. That's where we get some colored. Headline just hit today about Amazon cutting or expected to cut about 30,000 jobs was the headline that I saw. Again, they've got a lot of employees, but that's a pretty big number, I would say. And that cost cutting is part of this story that we'll probably learn more about through the course of this week as we start to dig through some of their earnings results. So again, overall, the Mag 7 in pretty good shape. And as you will see, as we look at the charts of breadth conditions, breadth is pretty decent. Today was okay, but the breadth last week was remarkably strong and really reversing what had been an ugly breadth picture at the beginning of October. The most important thing, right? The most bullish thing the market can do is go up. And we saw another gap higher today on the S&P 500. All right, let's get to the heat map. As a reminder, I appreciate you tuning into our market recap show every day. Please drop your questions on our YouTube channel. We'll be monitoring those questions. We had a fun all mailbag episode on Friday. I hope you had a chance to watch that and enjoyed it. If not, please take some time and go back there. Those questions all came from people like you in the last week, watching the show, analyzing the markets, watching the charts, trying to perform well in this environment of growth dominance. And questions are going to come up. Please consider me a place to throw some questions. Hopefully, I will answer one of your questions in our next mailbag episode, currently scheduled for Friday of this week. All right, here's what happened on the heat map, right? All the green. That's not true. There's some green elsewhere. But if you look at technology and communications, it's the biggest names having the biggest moves. And that is the story of this market. In the technology sector, NVIDIA and Apple obviously both having pretty strong days. Microsoft, Broadcom up as well. But as we continue through like the top 15 stocks, look at how big some of these names have been up today. Qualcomm up 11%. Semiconductors like Lam Research, like KLAC, like Intel even, all making new 52-week highs today. So that acceleration in semiconductors, Empower down the cap tier a little bit. All up in the green. So again, this is growth over everything. Could you describe these stocks as extended? You absolutely could. Could you describe these stocks as overvalued? I don't know how you couldn't, given where they are trading relative to current or expected earnings. But we have to remember is in a cyclical bull market, in a secular bull market, the market is driven by optimism about future earnings growth. And in a growth-dominated bull market phase, valuations always look high, right? Stocks always look expensive on the way up. Even if you are absolutely right, and if you are eventually proven right that we are currently in an AI bubble, which I would argue we probably are, that doesn't mean that the market can't go up a lot further and a lot longer than you might expect. And that is what I think is the reality that many are trying to get their head around. And that's what I would tell you. Go back and think in the mid to late 90s, how often you could have said technology was overbought or overextended or overvalued. And things just continued higher for quite some time. So even if you're right that this is a bubble, doesn't necessarily mean today is the top. And what I will tell you is what I've learned from analyzing a lot of trends over many, many years is you analyze the charts. As long as the charts are still strong, as long as the trend is still positive, we want to follow that trend as long as possible. That is what is giving me confidence to continue to follow growth stocks higher. What is also giving me confidence to start to change my thinking on charts like gold that start to change their complexion. All right, so outside of the big mega cap growth, the juicy tech consumer communications bubble, as we'll call it, outside of there, it wasn't a particularly great day. As a matter of fact, it was at best a mixed day. You're going to find pockets of random names that did well. You're going to find pockets of random names, particularly in like consumer staples and healthcare, that actually had kind of a rough day today. But overall, again, this was growth over everything. That's the name of the market here. All right, finishing off, let us continue looking at a series of charts together. The S&P chart gapping higher today. This gap that we saw on Friday, we saw another gap today. So Friday we gapped higher to trade above 6,800 for the first time in history. Today we gap higher again to close above 6,800 for the first time in history. I don't know how I get that out. Sorry. So we can see continued acceleration with the S&P closing above 6,800 for the first time ever. When I see gaps like this, what do? I often tend to just draw a little shaded area. I haven't done it here yet today, but I'll probably get to it through the course of this week. These gaps often are very important. I don't tend to have very specific rules for price gaps like that. What I tend to think is this is a gap that should be support, right? As we gap higher in an uptrend, I want to keep an eye on those gap levels, those gap ranges, because they often serve as support. That's why you can see some of these shaded areas actually come from gaps back here in June and May. I mean, this June gap is probably no longer super important. I put this on back there, kind of kept it updated as the price was kind of near that level. Now that we're pretty far away, I don't know if that gap from mid-June is going to have a lot of meaning anymore. So I'll probably delete it here for very soon. But when you have a gap, I often will throw just a horizontal range. On stock charts, use the rectangle tool, and you could probably do something similar on other platforms. But But I use that to just keep an eye on that range because that can be pretty significant. So for now, the 6,800 level pretty important given the gap that we've seen above there. Holding that gap this week, I would say pretty important. We failed to hold 6,800 through the course of this week. Not the end of the world, but certainly not an encouraging sign after this gap higher. Because what happens when you have a big uptrend like this, eventually you often have what's called an exhaustion gap, which is that very last gasp high, right? After a big extended move, sometimes that last gasp will be a gap higher. And if you don't see any further buying, if you see selling into that gap, that's what can be that can be a pretty classic topping pattern. A good example of why we draw gaps and keep an eye on them back here. This is in May. We gapped higher above the 200-day moving average. We highlighted that gap here. You can see we pulled back right into that gap. Ended up being right at the 200-day moving average as well, to be honest with you. Another thing that's changed here over the last week, we've seen the market move higher. We've seen the momentum go up with today's gap higher. We actually see the RSI pushing up toward the overbought region again. And we highlighted some of these bearish divergences that we saw in the S&P and a number of individual charts. We saw a similar divergence in July and August. That was negated when the market broke out on stronger momentum, finally, second week in September. So a breakout on stronger momentum would be a very bullish sign right about now. Now, what else tells us that the market is in a confirmed uptrend? We shouldn't be too worried about it. Newer Dow theory, adapting Charles Dow's original work, looking at the Dow Industrials and the Dow Railroads. I think a modern version that makes a lot of sense right about now is looking at the equal-weighted S&P and the equal-weighted NASDAQ. This is basically looking at the old economy versus the new economy, and are they all working? We can see that the equal-weighted ETFs, the RSP, which is the equal-weighted S&P in the top panel, the QQQE, which is the equal-weighted NASDAQ 100 in the bottom panel, both of those, as of today's close, have now made a new 52-week high. The fact that they're both breaking out means that is a bullish confirmed pattern that suggests that the trend is positive, and it's confirmed by these multiple parts of the major, tracking major components in the U.S. economy continuing to trend higher. All right, volatility. Let's look at the VIX here. You can see the VIX closed below 16 today. The last time we were below 16, you got to go back to the end of September. So, the VIX had spiked up around 25 in mid-October. That's when we were sort of waving a flag of caution because we had breadth deteriorating. We had the S&P pulling back. We had the VIX spiking above 20. Those are all signs that happen very commonly at major market tops. But what we did not get was a breakdown. We did not get a lower low. We did not get a break of support, a violation of our line in the sand at 65.50. This is honestly, periods like this last week are why we go with the line in the sand strategy. Line in the sand approach basically says once we keep making new highs, once we make higher lows, we keep bumping up sort of our initial stop, right? That line in the sand of the most recent swing low. That's why 65.50, which came from late September, so important. We pulled back to it in mid-October, but never broke below it. That's what tells us overall we're still in a constructive pattern of higher highs and higher lows. This week, we're making another higher high, which means we continue on. At some point, we're going to pull back. And do we make a higher low? That's the question. 65.50 still the line in the sand. For now, we might update that if we continue to break higher. But for now, lower volatility tells you the options market not showing a lot of concern right here as well. All right. If that's what's happening with the S&P, let's talk about some things not necessarily going up. As risk assets are breaking out generally, as equities generally driven by growth, looking quite good, as the major indexes, the S&P and the NASDAQ, making new all-time highs here in October. Gold had looked remarkably strong. The GLD closed above 400 for the first time in history. Spot gold, the gold future, closed above $4,000 an ounce for the first time in history here in October. We've now seen a pretty significant drawdown in the price of gold. The GLD is one of the ETFs that I hold in my own accounts along with the IAU. We've seen a pullback to the 21-day EMA. That's what gave us confidence last week to say, you know what? We haven't broken the 21-day EMA. We're probably going to consider this okay, unless that 21-day exponential moving average is broken. And that's what we saw today. With today's rally in stocks, today's sell-off in precious metals, the GLD below the 21-day EMA for the first time. You have to go all the way back here to mid-August. The last time we were actually below the 21-day EMA. That's how strong this uptrend has been. That's how much of an exponential rise it has been. Now that we're below the 21-day EMA, this is where I start to lighten up, which is what I'll start doing this week in my own account. Probably still have a decent position in gold, and the reason is because we're still well above the 50-day moving average. However, I think that short-term tactical pullback tells me to start to get a little more cautious, a little less optimistic, and look for signs of further breakdown. For now, the fact that that 21-day EMA has not held tells me to now expect further support around 345, 350. That would be the 50-day moving average. It's another 20 points below current levels for the GLD. Obviously, a lot bigger dollar value for the price of spot gold. We'll continue to monitor this one, but I think the gap lower today for me is certainly a short-term cause for concern. Now, long-term, the structure is still good, and the challenge you have with the chart like this, with the strength of the breakout, with the strength of the uptrend, is that initial sell-off can be quite significant, can be quite steep, and that's what we saw last week. This week, what we're hoping for is a nice recovery and a retest of those previous highs, but we didn't get it. Now, the RSI is still holding up okay. The RSI is still above 50, even with the gap lower today, and I think that's an important thing to watch. Watch the RSI to hold 40 on these pullbacks. That would tell me the primary trend, the primary structure is still bullish, but a break below the RSI value of 40 tells me we're more in a bearish configuration. For now, that long-term sense of trend is still okay. As we're above the 50-day, the momentum is still good. The short-term breakdown below the 21-day EMA, that's an initial stop for me, and that's where I start to lighten up. That's what I'm going to be doing here this week. I encourage you to join me in following that chart. We'll keep you updated as we see that trend evolve here. Wanted to point out, even though all the growth sectors were up today, we saw that on the sector performance list today. All three of those FANG sectors, leading the way higher. When we look at the last 6 to 8 weeks, it's really been technology over the other growth sectors. Here's communication services, and this is the relative performance of the communication services sector. Today's update, that's that little blip there, but the overall trend in the last 4 weeks has been underperformance for communication services. It's been underperformance for consumer discretionary. It's really been technology over everything else. And while some of those other sectors are showing some strength, if we get good earnings from some of those growthy non-technology names like Alphabet or Meta types of stocks, that's what can cause the relative performance in some of those other sectors maybe to improve a lot more than they have. But let's be clear, it's been technology as the strength overall in the last month, not those other growth sectors. Today's a bit of an aberration relative to the general trends that we've been observing, and you see that with the heat maps, right? With some of those big names doing well, but elsewhere in those sectors not as strong as you'd like. Now, again, what's driving this technology dominance? Semiconductor is really the story. This is the AI trade alive and well here at the end of October of 2025, continuing to push the price higher, while gold has broken its 21-day EMA. Let's note the fact that the SMH, which is a pretty widely followed semiconductor ETF, holding the 21-day EMA, now breaking higher, breaking above 350 on Friday today, breaking above 360 briefly. It did close right around $360 a share on improving momentum and certainly improving relative strength. Now, there are a lot of semiconductor stocks and technology names where the charts look fantastic. I think Empower is probably a fantastic example of the strength of the semiconductor trade since the end of July. August, September, October, we've seen new 3-month highs every month. We've seen the RSI consistently above the 50 level, not getting anywhere near 40 since the April market low. That shows you the strength in this uptrend, the strength in the momentum, the strength of the up days, and the minimal strength in the down days that is really defining the uptrend off of the lows. Here's Teradyne, not quite making a new 3-month high today, but bouncing off of the 21-day EMA a number of times here since the end of July. And again, I like that pattern of higher highs, higher lows, holding that initial level of support, RSI holding 50 all along the way. Here's another semiconductor name making new highs, higher lows, bouncing off the 21-day EMA, momentum consistently strong with the RSI above 50, relative strength doing well. I totally lied. It's not a technology stock. It's HCA Healthcare. That is a friendly reminder that just because a stock is not in a growthy sector, don't count it out. Just because a chart is a name like HCA Healthcare, which makes you, squeamish thinking about healthcare stocks and how weak of a sector healthcare has been, Don't count a chart out just because it's in a certain sector or just because you don't think it should do well. Charts like HCA are out there. There are charts in healthcare, in industrials, in materials that despite whatever you think about the macro headwinds or tailwinds, the charts look good. This is a friendly reminder that one of the great benefits of technical analysis is the chart doesn't care what sector it's in. The chart does not care what you think is going to happen to this stock. The chart is going to represent the overall sentiment of buyers and sellers, of supply and demand as reflected in the stock price. And if there are more buyers than sellers, if demand outweighs supply, if optimism outweighs pessimism, if greed outweighs fear, the price is going to go up. And that is what we are seeing on the chart of HCA. So not a semiconductor stock, but certainly a chart going up and to the right. Use your scanning tools, use alerts, use the tools on platforms like Stock Charts and others that you might use to identify those charts breaking out. We will do our best in the course of our normal market recap show to highlight some of those constructive charts. Certainly, we're there with our Market Misbehavior Premium members and our member-only community, highlighting those actionable charts as soon as we identify them. For now, I will say thank you all so much for tuning in today. Big move today. We've got a lot coming up this week with the Fed, with updates on U.S.-China negotiations, and with a lot of earnings. So please keep tuning in all week. We will react to earnings. We'll highlight some of the charts breaking out. If we do see some breakdowns, we'll do our best to highlight those as well. But for now, have a great Monday evening. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Have a good night, folks.